Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to earnings per share with convertible securities. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you're following along with OneNote and have access to it, you don't need to, but if you have access to it and want to follow along, we're on this section, the 1045, under the section Problem Presentations. I'm going to close this back up. We're going to go through the information for the problem, reading through all of the information for the problem. Then we'll go back and pull pieces of that information as we work through the problem. So first we have earnings per share with convertible securities. That's what we're going to be dealing with, calculating the earnings per share when we've got these convertible securities. So P owns a percent of S common stock. P is the parent, S the subsidiary, the percent owned 80%. December 31st, 2000 x 0, that's where the trial balances will be as of, and as of the time period that we will be creating, or that the period end as of December 31st, 2000 x 0, our earnings per share calculations. Then we have the S or subsidiary preferred stock, the percent at 8%, and they're convertible into common stock. So that means we're going to use that to calculate the basic earnings per share and the diluted earnings per share. Then we have S or subsidiary bonds. The bonds have a rate of 10%, convertible into common stock 8,000. We'll see the actual amount of the bonds when we get to the trial balance. So we'll see those on the trial balance. Then we have S net income. 2000 x 0 is going to be 50,000. When we look at the trial balance, we'll just be seeing the balance sheet. So we're going to need this information in terms of the net income for S, the subsidiary 50,000. Dividends that went out are going to be the 30,800. Then we have the preferred P preferred stock. P or parent, the parent also has preferred stock. The percent 11%. These are not convertible preferred stock. The parent also has bonds outstanding, which we will see the amount of the bonds when we get to the trial balances. The percent, 12%, these also not convertible for the parent. The P parent after-tax income, excluding investment income from S 2000 x 0. So P's after-tax income, 110,000. And then P's dividends are 68,000. The parent's dividends that went out, 68,000. Company files separate tax returns, so the tax rate is going to be 40%. So we want to calculate the basic and diluted EPS, earnings per share, for the consolidated entity. Here we have our information for the trial balances for the parent and the subsidiary. Parent and the subsidiary as of the point in time or the year end that we're going to be doing this information or the calculations of the earnings per share. This is basically the post-closing trial balances. So basically balance sheet accounts, the permanent accounts, not the temporary accounts. We see down here that we have the bonds payable on the books for P 280 S 200,000, the preferred stock here, and then the common stock. And note that this 10 and 5 represents the par value for the parent being the 10, the subsidiary being the 5. And then we're going to have our information that we just read up top in a more condensed format so that we can go back to it as we go into our calculations. So then we have our calculations down below. We're going to be taking a look at the basic earnings per share. We'll do this in a line-by-line calculation basis. So we got the parent income from operations. The parent income from operations are given to us here. Of course, that would be on basically the income statement for the parent company. That's going to be the 110,000. We're then going to say that S's net income is going to be 50,000. That's given to us in the data as well. So we got S's net income at the 50,000. We're pulling that into the inside for a sub-calculation. Now, the preferred stock, when we have the preferred stock, they typically get paid in terms of the distribution in dividends and in liquidation first. Therefore, we're going to allocate the preferred dividends out first for the subsidiary. So let's pull out the trustee calculator. So I'm going to pull up the trustee calculator. Hold on just a second. It went into the wrong screen, so I'm going to pull it on down here. So we're going to say the preferred stock, and remember this is S, and so we're considering the 90,000 preferred, so 90,000 times, and then we're going to pick up the preferred rate is going to be 8%. 0.08 is going to be that 7,200. So they're going to get paid first, so that's going to be the 7,200 that we're going to remove for the calculation of our earnings per share, which is on the common stock. So that's going to give us our earnings available at the 42,800, which is the 50,000 minus the 7,200. Then we have the S shares outstanding. So how many shares does S have outstanding? We can see here that S is going to be on the right side. We have the 100,000 for the common stock, and we see that they're 5% per par value. So 100,000 divided by 5 is going to be the 20,000. So 20,000 there. All right. And so then we're going to have the earnings per share for S is going to be the 2.4. 2.4 calculated as the 42.8 divided by the 20,000 shares. There's that 2.14, $2.14. So then we want to allocate that to the shares, multiply that times the shares held by P. So how many shares are held by P? Well, we're going to go back up top and say that P has 80% of the shares, and we said there's 20,000 shares. We're taking 80% of the 20. So we got the 20,000 times 0.8. That's going to give our 16,000. So 16,000. Then we have the contribution to P earnings per share, which of course is that 16,000 shares that P has of S. So 16,000 times the 2.14. That's going to give us our 34,240. There's the 34,240. Then we want to give the total earnings of P, which is going to be the earnings on P's books, the 110,000, and now the 34,240, giving us then the 144,240. Then we're going to have the preferred dividends of P that we're going to have to remove because they're going to get paid first. And once again, we're thinking about the common stock, dividend earnings per share calculation. So we got to pull out the earnings per share for the preferred shareholders. And so they're on P's side of things. We have P's side of things. We've got the preferred stock, the 200,000. So we're going to pick up the 200,000 and multiply that times P's preferred stock, which is 11 times 11. Hold on a second, 11%. Let me do that again. 200,000 times 0.11. That's going to give us our 22. So the 22 is going to be removed then. So we'll take out the 22. And then we have the earnings to P common shareholders, which is going to be the 144,240 minus the 22,000, giving us the 122,240. Then we want to see P's shares that are outstanding. How many shares does P have outstanding now? We're going to say, all right, they've got the common stock for P is 150, and they have the $10 par. So 150,000 divided by the $10 par. We've got the 15,000 shares outstanding. So outstanding shares, 15,000. And then finally, we're going to be calculating the basic earnings per share, which is the 122,240 divided by the 15,000, giving us about 8.15. Next, we're going to do a little bit more complicated of the calculations, and that's going to be the diluted earnings per share. So we're going to have our same information up top. We're going to add our information here again so we can get to it a little bit more easily. And then we're going to go to the diluted earnings per share, which means basically we have this convertible information that could happen. So now we're going to think about, well, what if there was a conversion that took place and have the convertible earnings. All right, so then we have P income from operations, same starting point, 110,000. P's income, net income. Then we're going to go to, once again, the S net income, which is the 50,000. We're going to pull that into the inside. That's going to be this number. That's where it's coming from. Then we're going to assume the conversion of the bond interest effect. So in other words, we have the bonds up top for S. And the bonds are here. They could be converted into 8,000 common stock. What if they were converted to the common stock? Well, one effect would be the fact that the bond interest would no longer have to be paid, and there would be tax effect on the interest. So that, if you pay interest for the bonds, then you have to pay interest. But on the plus side, it makes you look bad, which means your taxes go down. So we take that into consideration. And the other thing, of course, then you would have the common stock going up of the 8,000. So let's think about the tax effect first. So we're going to say, all right, because we're thinking about what's going to happen to the net income here. So we've got the bond is the 200,000. That's coming from here on the trial balance. And then we're saying the rate is 10%. That's coming from here in the data. Then we're going to say that the interest would be 20,000, the 200,000 times the 10% on the year. Tax rate then 40%. That's coming from our data, 40% tax rate. So we'd have to pay 20,000, but then we'd get a 40% basically, deduction for it. So that's 8,000, 40% of the 20,000. And therefore the tax effect is the 20,000 minus the 8,000 or the 12,000. That's the interest impact that we're going to be then including in with the 50,000 if there was a conversion. So then we're going to say the earnings available are going to be 62,000, which of course is the S's earnings, net income plus the interest effect for the 62,000. Then we got shares, S shares outstanding are going to be the 20,000 shares outstanding, once again calculated as the, this is S right here. S has the 100,000 and the par value is $5. So we're going to be picking up that 100,000 divided by 5. There's our 20,000. So we've got our 20,000. But then we're going to assume that the bonds are converted. So now we're calculating the number of shares in our diluted calculation. Well, if the bonds are converted, then that would be another 8,000 shares. So now we're talking about the other side of the effect of the bonds. One would be effect on the interest, affecting net income, the other on the number of shares. Then we assume the conversion of the preferred stock, because we had up here that S could have preferred stock that was converted to a 13,000 shares. So then we'd have the 13 shares. The 20 plus the 8 plus the 13 is going to give us that 41,000 shares. So then we have the computed earnings per share for S would then be our earnings available of the 62,000 divided by the 41,000, or about 1.51. 1.51. And then we're going to have the shares held by P. How many shares are held by P? Well, they hold 80% of the 20. So we're taking the 20, not the converted items, times the 0.8, and that's giving us our 16,000. And then we have the contribution to P earnings, which is going to be the 16,000 shares that are P's of S, and then times the 1.51. That's the 24,195 about, because there's rounding as you saw in this 1.51. Then we're going to have the total earnings of P, which will be, and before we do that, let me just show you the kind of a rounding effect here, because we saw that if we took this 62,000, I'm sorry, if I take the 62,000 divided by the 41,000, that's going to give us our 1.51 about. But let's keep it unrounded here. Now let's take this number and then multiply it times the 16,000, and that's going to give us our 24,195. Again, still rounded to the dollar at this point. All right, then we're going to be taking our total earnings, which is going to include our earnings up top, the 110,000 plus the 24,195 to get the 134,195 total earnings. Then we have the preferred dividends of P that we got to pay the preferred dividends first. So scrolling up, same calculation we did last time for the preferred dividends of P. So P has the preferred dividends of the 200,000. So we'll take that 200,000 multiplied times the 11%, 0.11. That's going to give us our 22,000. So we're going to remove then the 22,000, and that'll give us our earnings to P common shareholders of the 134,195 minus the 22,000, or the 112,195. Then we have P shares outstanding. So P has 15,000 shares outstanding. Calculating that same way we did before, in that we see that P has common stock of 150,000, $10 par. So we're going to say, all right, 150,000 divided by 10. That's going to be our 15,000. So we've got our 15,000. And then we're going to say that we have then the 112,195 divided by 15,000. That's going to give us our 7.48 about.